Hi, and welcome to Chapter 10. So, since this is the first purely macro chapter, I thought it would be a good idea to do a quick review on what micro versus macro is. Okay, so microeconomics is the study of individuals in the economy, whereas macroeconomics is the study of the economy as a whole. So instead of looking at maybe prices and quantities of individual firms or individual marketplaces, we're going to think about, well, what's the quantity that's being produced in the country as a whole, and that's kind of the idea from macroeconomics. And so one of the questions perhaps we might answer is, or we might ask is, what's the quantity from the whole country? And so one of the things that we might study is the productivity of the marketplace as a whole, or everybody in the entire country. How much production do they create? And so economists have created a tool to measure that, and we call that the gross domestic product. Okay, and so basically, this is really important to note that it's the important piece here is product. This is a measure of production. It's a measure of goods. It will end up being in dollars, but it's a measure of the goods, the quantity of goods that the economy produces. It also happens to be the income of everybody in the economy. So it's actually really a handy tool for figuring out the welfare, or how everybody is doing in the economy. Okay, because if you zoom out to the economy, the level of the economy, any income from one person, right, every single amount of money that's gained from one person has to be an expenditure by somebody else. So this is a really cool kind of shortcut that economists devised, was that the total income is equal to the total expenditure at the economy-wide level. So if I want to understand the domestic product, I can either measure the income or the expenditure. Because of this point that I just explained, that income equals expenditure when you look at the economy as a whole. Okay, so to remember how this works, why income equals expenditure, we're going to go back to the circular flow diagram from Chapter 2. It's a really simple depiction of the macroeconomy, but it does illustrate GDP as any of these four items: spending, revenue, factor payments, and income. So I can actually measure either of those four, and it will all give me the same amount of dollar value for GDP, or really closely. It's called the statistical discrepancy when it's not exactly the same. But in case you forget what factor payments are the payments for factors of production. So factors of production are inputs used in the process of production. So we have labor, land, capital, natural resources, and then of course the factor payments are payments to the factors, payments for labor or payments for land or capital. And so let's go ahead and look at the circular flow diagram. There are two actors. Remember, households and firms. And households, they own the factors of production, and then they sell them to the firms. So what's going on here? Households here are owning anything that's used for production. Maybe just for the purposes of this model, they're owning tractors, they own capital equipment, they own labor. That's kind of why it's really important. And what they do is they rent it out here to the firms. And then the firms go ahead and pay them factor payments when they get it. Of course, the households also buy and consume the goods and services. The firms, all right, so they get the factors of production from the households, and they pay for them. And then they also, of course, produce the goods and services. Okay, so let's look at our first marketplace. The first marketplace is the markets for the factors of production. These things like labor, land, and capital that are required to produce goods, right? Households send them to the firms, and the firms use them in production. Firms have to pay for these. They pay for them using wages or rent or profit, right? Wages is the, quote, rental rate for labor. Rent is the, quote, rental rate for land and capital. All right, and so already we see this very interesting piece right here, that wages and rent obviously is the same as the income that the households get. So the wages and rent that the firms pay is the same as the income the households get, because it's the same dollars. And then it's all the same as the gross domestic product, or the total amount of production made in the country. Okay, so we're trying to get to how to measure GDP, So this is a little kind of foreshadowing of what we're perhaps going to do. Okay, so then there's the markets for goods and services, which is what we're actually trying to measure. How much goods and services can this economy produce? The households obviously spend for these goods and services, and the firms sell them to the households. Okay, so just so we remember what we're trying to do here, the goods and services that are being produced in the economy is actually what we're trying to measure here. But it just so happens is that all the goods and services bought is the same amount of money that is spent on the goods and services. So instead of trying to measure individual goods and services, perhaps it's just easier to measure the amount of spending spent on it. And that just so happens that it's equal to GDP because it's the amount of goods and services, the amount of the product that is being produced. And so if you look at this really cool diagram, you see that spending is equal to revenue, is equal to the wages, rent, and profit, is equal to income. So basically what this is telling me is that I can measure whatever is easiest to measure out of spending, revenue, wages, rent, and profit, or income. I can measure any of those, and it will give me a pretty accurate idea for gross domestic product. All right, the things that this diagram is missing out on is the government, obviously. They collect taxes. They do buy goods and services. So if I really am cared about all of the amount of goods and services produced in a country, i.e. GDP, I'm going to have to somehow account for this government, because if I just measure the amount of things purchased by private citizens, it's going to be a smaller number than the full amount of productivity actually in the government. We're forgetting about the financial system, basically banks that makes loans, and we're forgetting about the foreign sector, right? Because foreign countries also buy our products. So if I want to know the total number of goods and services produced in a country in a certain amount of time, and I only look at the amount of products purchased by the citizens of that country, I'm going to miss all of the productivity or all the products that are being sold outside of the country as imports. So basically, in a couple seconds here, I'm going to go ahead and deal with the government. Oops. We're going to add the government, and we are going to add the foreign sector into this model. Okay, so what is GDP? Here's the formal definition. It is the market value of all final goods and services produced within a country in a given period of time. What does that mean? Okay, first, market value. This is crucial, and it's kind of a shortcut. Instead of making a listing of all of the products that are being made, which is what GDP is trying to measure, we just report the dollar value of their market price. It's just kind of a shortcut to explain all of the goods and services. So they're measured in the same units, so I can just clump it into $1. But the problem with that is that things that don't have a market value, for example, housework we do for our own selves, or a meal I make for my own self, there's no dollar value on that, so it's not included in productivity, which is a bummer because I really want that included in productivity, because a meal I make for myself is a productive use of my time in society. All right, and it is the market value of all final goods. So just goods that are intended for the end user, not intermediate goods. These goods are used as components or ingredients in the production of other goods. Why aren't they included? Because the market price of the final good already includes the value of the intermediate good, right? So a computer, I only include the total sale price of the computer. I don't include the price of the hard drive inside or the microchip, because all of those are already picked up in the price of the final good. And if I added them in there, it would be double counting. Okay, what do I actually count? I count goods, such as DVDs, mountain bikes, beer, and services, things that are intangible, right? Dry cleaning, concerts, cell phone services. These things increase the welfare, so they're important. They're a piece of the productive society, so they're important to include in GDP, as well as the actual goods. All right, so next, it's produced in this year. GDP is per a certain time period, generally a year or so, and it only includes things that are produced this time period, not goods that are already produced in the past, because that's already been included in the GDP from the past period. All right, so we're looking within a country because that's what we're looking at, gross domestic product, right? How is this country, how much production is this one individual country? So an important thing to note is, let's say a foreigner comes into this country, their productivity is counted in the GDP. Let's say that one of the citizens of our country goes to another country and is productive over there. That's not counted in the GDP for this country over here. And then finally, we measure it within a given period of time, usually a year or a quarter is the traditional periods of time. Okay, so GDP. Remember, it is just total spending, which is equal to total income, which is equal to the total amount of products made. For purposes of this class, we're going to calculate GDP. There's a number of ways to calculate it. We're going to calculate it with looking at spending. This is also known as the expenditure method. Okay, so every dollar that's spent in this country, in America, can be categorized into one of four categories. It can either be something bought for consumption, something bought for investment, something bought for government purchases, or something bought for net exports. We just add them all up and we get Y. So this here is GDP, GDP. Wow, that's pretty messy. GDP. And these are, consumption, investment, government spending, and net exports. Okay, so we're going to add them up, and it's going to equal Y. It's the letter Y is used because really it stands for income, but but the letter I is already used for investment, so it couldn't be used again. So now we're stuck with Y to mean GDP. Let's look at each of these individually. Consumption. It's total spending by households on goods and services. Okay, so this is a very simple component. If I go to the store and I buy some macaroni and cheese, boom, the dollars I spend go into consumption. The only hard part is housing costs, okay? In consumption, renters, they pay for a product. It's called housing. So the rental price that a renter pays for their house is included. Now, for homeowners who don't pay rent, there's still an opportunity cost, right? If they were to move out of their home and have somebody move into their house, they would get some rental rate. So technically, it's still, quote, costing the homeowners money. It's just whatever the rental rate would be. So what the government does is they calculate an imputed rental value, which is basically the number of dollars that someone would pay you to rent your house if they were renting your house from you, okay? And that is considered an opportunity cost, which the homeowner is paying, and that is included in consumption, okay? So the two pieces of housing that's included in consumption is rental payments and imputed rental value, okay? The actual purchase price of the house does not come in here consumption, okay? I'll explain to you where it comes into here in a second. All right, the next piece is investment. So this is total spending on goods that will be used in the production of more goods. So if you build a factory, the money you spend to build a factory goes into investment for that current year, okay? And so it includes spending on the capital equipment. Let's say I buy a tractor for my farm, okay? That goes into investment. If I build a factory, build an office building, or build a house, okay, that goes into investment. So if I buy a house in the year 2014, the purchase price of the house, okay, the purchase price of the house goes into investment, right? But then every subsequent year after that, the rent or the, quote, imputed rental rate, the amount of rent someone would pay me if they moved into my house, that goes into consumption, okay? And then the other thing, investment is a bit of a weird thing. It also includes inventories. All right, so if at the end of the year a bunch of goods have been produced but not yet sold, they still have to get counted somewhere, even though they're not going to be counted in consumption because no one's bought them yet. They get counted into investment. Basically, goods that are sitting around on shelves that haven't been purchased yet. Okay, so investment does not mean the purchase of stocks or bonds like you'd think. Like we normally use the word investment. It means things that are purchased to make a productive use of goods. All right, and finally there's government purchases. So we also have to include the money the government spends on goods and services, because if we just think of the goods and services purchased by people, there's going to be a lot of goods and services that we miss counting. And remember, we want to count all of the production or the productivity of my country. It also excludes transfer payments, such as Social Security or unemployment benefits, because those are just transfers of wealth from one person to another, from the government to a person, and they're not purchases of goods and services. Really, it's kind of like a negative tax. And then finally, there's exports, all right? So net exports is just exports minus imports. Okay, why do we add in exports but subtract off imports? Because exports is foreign spending on the economy's goods and services. So if I'm trying to figure out how many total goods and services are produced in the country, and I only look at what people here in this country buy, I'm going to miss if we shipped any goods overseas to another country. I'm going to miss counting those. So I have to add those back in. Furthermore, let's say I have an import and I buy a bottle of wine from Argentina, right? Consumption is going to go up by $10. Let's say the bottle costs $10. Consumption is going to go up by $10, but I don't actually want GDP to go up by $10 because that wasn't something that an American made, right? So I have to actually subtract that $10 off here from imports. So the $10 is going to go into the consumption and go plus 10 in consumption, but it's going to come out here at exports and minus 10, and the total change into the GDP is going to be 0 because it's not something that's produced here in this country. Okay, so there's the formula once again, and to reiterate, if I do buy that bottle of Argentinian wine, right, this will go up $10. Okay, and the net exports will go down $10. So what's the change to my GDP? It's 0. All right, and as it should be. Okay, so here's kind of an interesting chart. Here's the United States GDP and its components in 2012, right? Our total GDP is about $15,000 billion. So 15,000 billion is the same as 15.8 trillion. And here's the amounts that it is. There's about 11 trillion in consumption, 2 trillion in investment, 3 trillion in government spending, and 533 billion in net exports. This means that we import $533 billion more than we export. That's what that means. And then it's also very interesting perhaps to look at it as a share of GDP, right? 70% of all dollars spent in America are for consumption, right? About 20% of all dollars spent in America is through government spending. And then if we break that down to per person or per capita, it works out to be about $50,000 per person in GDP. Okay, so here's a quick exercise you can do. Take that formula, y equals c plus I plus g plus nx, and figure out which one of these, in each of these events, figure out which one of those things change and if that makes GDP change at all. Why don't you go ahead and click pause and try to do this on your own, and then come back to me when you're ready. All right. So, in case A, Debbie's spending $200 to buy her husband dinner. Consumption goes up, right? The C goes up by $200. Therefore, that's going to make Y, or GDP, go up by $200. All right, imagine Sarah spends $1,800 on a new laptop, but it was built in China, okay? So, when she buys the $1,800 laptop, that's going to go into investment, right? It's going to go up to $1,800. But it is an import, so I have to subtract it off, right? So net exports fall by $1,800, and therefore GDP is not changed. And that's what I want. I don't actually want GDP to change because this laptop was not produced in this country. Okay? Next, imagine Jane spends $1,200 on a computer in her editing business. She got last year's model on sale. Okay, this is important because although the $1,200 went into investment for the GDP of last year because it was inventory, right? In this year's GDP, current GDP, it's not going to change at all because, yes, she's going to buy something for investment and it's going to make investment go up, but investment's going to go down $1,200 because inventories decreased $1,200, right? When the computer left the shelf and was bought, so those exactly cancel each other out and it's no change. Finally, General Motors builds $500 million worth of cars, but we only buy $470 million worth of them. Consumption goes up by $470. Inventory investment, stuff sitting on the shelves, goes up by $30 for a total GDP increase of $500 million. All right. Now, obviously, there's a bit of a problem here. You're using prices to measure products, and I really only care if products, the number of products produced increased. If the price goes up, that's called inflation. That's going to make GDP go up. All right, so they created a new form of GDP. The old form, like we've been studying, is nominal GDP. It's just using the current prices. It's not corrected for inflation. But then they also created this thing called real GDP, and it uses the prices of any old base year, just one base year, and for every time you calculate GDP, you use the prices from this year, and therefore the prices don't change from year to year. So we say this is corrected for inflation. Real GDP is the much more useful measure of production in economy. Okay, so look at this economy. It's very simple. They only make pizza and lattes. Right? And so if I want to compute the nominal GDP for 2011, I simply just figure out how many dollars were spent in 2011. Okay? $10, and they spent on 400 pizzas, so that's that piece, right? $2 times 1,000 lattes, that's that piece, so the total GDP is $6,000 for 2011. The nominal GDP for 2012 is 11 times 500, and then 250 times 1100, and the nominal GDP for 2013 goes up to 10,800. Now, these are big increases in GDP. You see there's a 37.5% increase and a 30.9% increase. By the way, if you don't remember how to calculate percentage change, I'm going to say percentage delta because delta means change, okay, is just the new price minus the old price divided by the old price times 100 to get a percent. Okay, and so that's what I did here to calculate these guys, right? I just went 8,250 minus 6,000 right here. Okay. But back to what we were talking about. So this looks like huge increases in GDP. You might think, wow, this country's getting really a lot more productive and they're producing a lot of things. But the problem is the increases are due both to increase in price and increase in quantity. I only care about increase in quantity, so I got to get rid of this increase in price thing. So what I do is I just calculate it using 2011 prices all the way through, right? So I use $10 and $2 for the prices of these goods all the way through my calculation. And then I get these values for GDP. There is still an increase, but it's much more modest. But the good thing is this increase has to do with the increases in quantities, which is what I'm interested in. Okay, so if we compare, nominal GDP is measured using whatever the current prices are. Real GDP is measured only using the prices from 1 year. It doesn't matter which year you pick, but you pick a base year and then you use them for all of the GDPs that you calculate. Okay, so when we have an increase here, that's due to both price and quantity increasing. When I have a change here, that's due to just quantity increasing if prices were constant, meaning zero inflation. Okay, so that's why we can say real GDP is corrected for inflation. So if you look, here's the trends of real GDP and nominal GDP. Real GDP has been climbing, and really what we care about is GDP that's been corrected for inflation, which is the red line. Okay, then there's this idea. There's a GDP deflator. It's really quite unlike GDP. Whereas GDP is a measure of the products, GDP deflator is a measure of the overall level of prices. It's like asking, how much do I have to take away from the nominal GDP to get to the real GDP, right? And it's an alternate measure for the economy's inflation rate. All right, and if you just look at how much the GDP deflator changes from 1 year to the next, you have a pretty good idea about the inflation. Let me give you an example. So if I calculate the GDP deflator for 2011, right, it's going to be nominal GDP over real GDP. Well, they're the same because we're using the base year of 2011. So the GDP deflator is going to be 100, meaning there's no change due to inflation that year. Now, between 2012, right? So I take nominal GDP divided by real GDP, multiply it by 100, I get 114.6. So the prices are 14.6% higher than they were in 2011. When I do it in 2013, I get the GDP deflator is 128.6, meaning the prices are 28% higher than they were in 2011, higher than in my base year. If I break that out per year, this is easy. It's 14.6% this first year, and it's 12.2% the second year of increase. All right, so why don't you go ahead and and calculate these three things. Hit pause, do the problems, and then come back to me when you're ready. All right, nominal GDP in 2011, very easy. Prices and quantities from 2011, 46,200. Real GDP in 2012. Well, I used the quantities from 2012, but the prices from 2011 because 2011 is the base year. Okay, and then I'm left with $50,000. And then finally, I need you to compute the GDP deflator for 2013. This is going to require you to calculate both the nominal GDP from 2013 as well as the real GDP from 2013 and then divide them so you get this, meaning that prices were 12% higher in 2013 than they were in 2011, the base year. Okay, so remember, GDP is supposed to give us our idea of how the country's doing. Another word for it is economic well-being. This is important. Real GDP per person, right? So you take the real GDP that we just calculated, divide it by the number in the population. Real GDP per person or per capita is the main indicator of the average person's standard of living. It's just what is used throughout the world. Unfortunately, there's a lot of problems. Robert Kennedy, he was a senator, he said the following. All right. He said that GDP does not allow for the health of our children, the quality of their education, or the joy of their play. It's true. None of these things are actually incorporated into GDP. It does not include the beauty of poetry, the strength of our marriages, the intelligence of the public debate, or the integrity of our public officials. It measures neither our courage, nor our wisdom, nor our devotion to our country. It measures everything, in short, except that which makes life worthwhile. And it can tell us everything about America, except why we are proud that we're Americans. Right, so he's got this idea that he's kind of anti-GDP. Unfortunately, he didn't have a better option than GDP, which is kind of just where we're all stuck with. Okay, here's the things it misses out on. GDP does not value the quality of the environment, right? You can be producing a lot of goods and also be polluting a lot, and GDP will still go up. Okay, it doesn't value leisure time, right? If you are producing more things, you might have less vacation. That might be a bad thing, right? And then, of course, there's this problem we already talked about, is that if anything is done not in the marketplace, if you watch your own kids, that's still productivity. It should be counted in GDP, but it's missed because it doesn't have a dollar value. And it also doesn't talk about an equitable distribution of income. I'm sure you realize that mathematically, if just one person got super, super rich in the country and everybody else had the same amount of poor money, they were very poor, that would make GDP per person raise up. But really, the people are not getting better overall. Okay, so why do we care about GDP? Well, first of all, remember GDP is income, so if the country has a higher GDP, they can afford things like better school, cleaner environment, healthcare. Additionally, many indicators of well-being are positively correlated with GDP. Let me give you a couple examples, right? So you see in this graph that life expectancy and real GDP per capita look like they kind of have this increasing sort of thing like this, right? So as you get higher GDP per capita, at the same time life expectancy starts going up. It's important to note that these not saying that it causes it, but however that they both happen at the same time. It's correlation. Okay, the same thing if we look at GDP and literacy. It appears that people who are richer at the same time can read more, which is a good thing, right? And it also appears that internet usage also goes up as GDP per capita goes up, which is another very important piece to improve the well-being of life. So we study GDP. It's interesting because it does seem to have good correlations with positive effects of economic well-being.